Welcome back. Thank you for watching my videos. I've enjoyed our time together and we're basically family now. I just really appreciate you taking the time to watch. And if you've already clicked the subscribe button, thank you. Today we're in chapter 3 and I want to be very clear and upfront with you. This chapter is very test heavy. Some of the concepts that we're going to hit on are test heavy. So you're going to see direct questions, you're going to see math questions, and you'll see priority questions. And if you don't understand this chapter, it will cost you points on the exam. But here is the good news. This is one of the chapters where we'll jump in and start building on top of other concepts. If you understand the why, the test becomes easy. By the end of this video, it's all going to connect together, and I've also provided you with a resource for you to take notes with below in the comments. So here's what we're going to cover. This is a big chapter, and we're going to break it down into 4 main parts. First, we're going to talk about property taxes in North Carolina, including the North Carolina Machinery Act and how property is assessed. Next, we're going to walk through the tax timeline, when taxes attach to the property, when they're due, and when they become delinquent. That is something you will see on the test. Then we're going to shift into liens. What are they? How they affect the property, and most importantly, who gets paid first. The priority piece is critical. And finally, we'll spend time on the math. How to calculate property taxes, how to walk through the formulas, and how to avoid the common mistakes that cost people points. If you can follow these 4 sections and understand how they connect together, you're going to be in great shape for the exam. So let's jump in. Section 1, the North Carolina Machinery Act. Let's start with this foundation. The North Carolina Machinery Act, this is the law that controls how property is assessed and how property is taxed. Now, here's your first knowable concept. Assessed value is not market value. It is different. Don't get tripped up here. The value is not updated constantly. So the appraisal is done every 8 years, but the rate can change every single year. So if your current tax rate is 2%, it could be 2.1% the next year. So what does this mean? You could have a home worth $400,000 today, but the assessed tax value is $300,000 because of the last reassessment has not caught up yet to the market value. For example, if you see Zillow or Realtor.com says $400,000, but the tax record says $300,000, that is normal. Don't overthink it. Now let's move on to section 2, ad valorem taxes. You will see this term ad valorem. That means according to value. So taxes are based on the value of the property. So more expensive homes, higher taxes. Less expensive home, lower taxes. Lower taxes. This is the one where I want you to feel comfortable on and also know the dates. We're going to talk about tax timeline. January the 1st, that's when tax liens attached to the property. Happens in advance. September the 1st, that's when taxes are due. January the 5th of the next year, that's when taxes are delinquent. So for a quick memory trick here, lien January 1, due September the 2nd, late January the 3rd. So here's the thing, the government does not wait. They don't hope you pay. They don't chase you down first to pay. They secure their lien position first. So what does that mean? Before anything else, before a mortgage, before a contractor, before anyone else, they placed a lien on the property January the 1st. So know why that matters. Because when you sell, refinance, or even foreclose, they get paid first. So let's talk a little bit more about liens and priorities. What is a lien? A lien is a claim against a property for a debt. Most important idea about this is lien only matters because it gives the right to foreclose. Now, for clarity's sake, no lien, no foreclosure. No foreclosure, there is no leverage. But they are a priority of liens. This is a big topic here. Here are the order of liens. The first lien on your property is the property tax. That will always be first. The next lien holder will be special assessments. That could be city repaves your street, the city installs sidewalks for safety, area upgrades from septic system to city sewers, installation of neighborhood lights. If unpaid, then those things become liens on your property. Mortgages are probably the most common lien that you'll experience because you choose to have that lien on your property because you got a mortgage to purchase that property. Then there are other liens, such as from HOAs or mechanic liens. Mechanic liens is a lien placed on a property by someone who did work or provided material on your property that did not get paid. Now here's why this lien order matters. Whoever is first, they get paid first. And normally in real estate, there is not always enough money to go around. And so if a home sells in foreclosure, there might not be enough money to pay the bank or the contractor or anyone else. So that is why the government gets paid first. They put that lien on the property first. They're the first lien holder. So what are the different types of liens? Let's break it down just a little bit different or a little bit deeper. Specific liens, examples would be mortgages and property tax. Those are specific liens. General liens, those would attach to the person. Those are things like IRS debt and judgment. So specific liens, mortgage, property tax, they attach to the property. General liens, IRS debt and judgments attached to the person. So if you don't pay the IRS, they could come after everything. Your house, your car, your bank account, etc. So understand and remember that specific is for property, general is for the person. Know the difference. Now let's talk a little bit more about special assessments. We hit on those a few moments ago. The key point about special assessments is remembering that the city repaves your street and the city may install sidewalks for your safety, area upgrades for septic systems to city sewer, neighborhood lightings. These become liens if they're unpaid. But the thing that we need to understand is that they are not voluntary. You don't get to say, no thanks, I don't want that sidewalk, I don't want those street lights. You don't. And so a special assessment, it goes after the taxes, but before the mortgage. So taxes first, then special assessments go next on the property. Then what would be next? The third lien holder on your property would be a mortgage. Now let's talk about math. Don't get stressed out about the math. There is math on the exam, but it's not a math exam. So ad valorem tax. This is where we'll start at in North Carolina. In North Carolina, we use ad valorem tax. Ad valorem simply means according to value. We touched on that, but let's get into the math. This is where people panic, but you don't need to. It's pretty straightforward. The core formula for ad valorem tax is assessed value times the tax rate, then that will equal the tax bill. In an ad valorem tax, you are not taxed on market value. You are taxed on the assessed value. Remember what we spoke about a little bit earlier? Assessed value is different from market value. So for example, that you may see on an exam may read like this. What is the annual tax bill for a property assessed at $500,000 if the tax rate is $1.50 per $100 of value? So the first thing I want you to notice is that we were already given the assessed value, so we do not need to calculate it. So now let's focus on the tax rate. The tax rate is $1.50 per $100 of value. So when you see per 100, move the decimal 2 places to the left. Do from $1.50 to 0.015. Now apply that formula, value times rate equals tax. We're going to plug it in. So now we've got the $500,000 assessed value times the 0.015, that equals $7,500. The annual tax bill then is $7,500. So if you ever get stuck, stop and think, what makes more sense for taxes on a $500,000 house? $750 or $7,500? It could be just a simple mistake in moving the decimal. But if you could have the answer, you could have the wrong answer using the wrong formula in the answer. So whichever answer seems to be correct for a $500,000 home, and that would be $7,500. Let's talk about rate conversions. This can be very testable. So this is one of the topics that can trip people up if you don't slow down and really understand. We've talked about ad valorem taxes in North Carolina. Now let's talk about mill rate. Other states use mill rates, and I promise you this is easier than it sounds if you just remember where to move the decimal. And so with the mill rate, they don't use per 100. The mill rate they use per 1,000. So it's $1 per 1,000 of value. If it's 1 mil, it's $1 per 1,000 per 1,000. So instead of $100, it is $1,000. If I say the tax rate is 15 mils, that means it's $15 per 1,000 of value. So now let's take that 15. We're going to move the decimal place over 3 places. Now you got 0.015. Same math. 5,000 times 0.015, that gives us 7,500. So let's make this real simple. North Carolina is per 100. Other states are per 1,000. But at the end of the day, it's the same calculation. Now, where I see people get tripped up is first mistake, moving the decimal place the wrong place. So per 100 equals 2 places, per 1,000 equals 3 places. The second mistake I see, thinking that this is 2 different formulas. It's not. You have the value times the rate equals the tax. The third mistake, overthinking. Don't do it. Read the question. But on another note, if they split the tax rate by county or by city, and the property we're talking about is both located in the city and in the county, then you'll need to add the tax rates together. So they could say the tax rate of the county is 1%, and the tax rate in the city is 2%. So that gives you a tax rate of 3%. Now, however, there will be a trick question where it specifically says that there is a tax rate in one county and a tax rate in the city, but it says the property is only located in the county. It's not located in the city. So that means you don't use the tax rate, the city tax rate. You only use the tax rate for the county. And finally, before wrapping this up for this section of math, you have tax prorations. For tax prorations, you need to determine who's paying their fair share of taxes on the day of closing and how much will they be paying. The seller actually pays the day of closing taxes. So if we close on May the 28th, they are responsible for the May 28 taxes. The buyer taxes don't start until May 29th. So let's look at some common test traps before we wrap up. Trap 1 is using the list price instead of the sale price. Trap 2 is forgetting the assessment percentage. Chap 3 is mixing up per 100 versus per 1,000. Here's how I want you to remember it. The more zeros, the more moves. $100, 2 zeros, move 2 places. $1,000, 3 zeros, move 3 places. Chap 4, forgetting lien priority. Remember that property taxes always go first. And finally, what you must know, if you know this, you're in good standing. North Carolina Machinery Act, ad valorem tax, tax timeline, tax lien priority, special assessments, and then the tax math. Here's the bottom line. This chapter is not about memorizing random facts. It's about understanding how money flows in real estate, who gets paid first, how taxes are calculated, and how property value impacts everything. If you could think through that, you'll do well with the exam. Don't forget to subscribe to my YouTube video channel for more exam prep. And as always, feel free to reach out if you have any questions. I am always here to help you from licensing to close.